Stop scrolling. Silver just broke something, and almost no one is talking about the right part. China's paying $128 per ounce for physical silver right now. US Comex silver, around $111. That's a $17 premium for the exact same metal, today. Not forecast, not theory, and here's what makes this different. Nearly 1 million ounces just walked out of Comex warehouses in a single day. If you're holding physical silver, this matters. If you're watching futures prices, you're watching the wrong screen. If you assume paper contracts still set the real price, that assumption is cracking. If you're here now, watching this before it hits mainstream finance channels, you're ahead of most professionals. I'm going to show you patterns, not predictions, tools you can use tomorrow morning. But the real risk here, it doesn't show up in price charts. We won't touch it until later, before we go further. Subscribe, not for hype, for early pattern recognition. You're joining the group that watches structural stress before headlines scream about it. Let me lay out what's actually happening right now. Global spot silver trades around $111 per ounce. Shanghai physical market, $128. That premium, that gap, just hit historic extremes. Comex registered inventories are draining, fast. We're talking massive daily withdrawals that most retail investors never see reported. And here's what matters. This isn't retail stacking noise. This is industrial buyers and regional demand refusing paper settlement. Think about that. When you see premiums explode like this, the market is telling you where silver is scarce, not how much exists globally. Paper silver trades calmly, orderly, liquid. Physical silver is being yanked out of the system. One flow stays smooth, the other is grinding to a halt. The hidden layer, price tells you what people will pay. Premiums tell you what people don't trust. Right now, someone is paying $17 extra per ounce to avoid the paper system entirely. That's not bullish noise. That's a preference shift. When industrial users, the people who need actual metal to manufacture products, start paying up to skip futures contracts, you're watching confidence leave the building, not market confidence, delivery confidence. And we've seen this exact setup before, just not in silver. Let me show you the mechanism. I call it the physical escape valve. Here's the metaphor that makes it click. Futures markets are a dam. Physical demand is water pressure building behind it. Premiums are the leaks, small at first, until the wall cracks. Here's how it works in the real world. Paper contracts clear easily, smooth, liquid, no friction. Until delivery actually matters. The moment buyers need metal now, not a promise of metal in 90 days, price becomes secondary to access. You'll pay up. You'll take the premium hit. Because missing your manufacturing deadline costs more than $17 per ounce. When this shift happens, futures stop leading. Physical leads. The paper price becomes an artifact, a lagging indicator of what already happened in the physical market. Why does this pattern repeat across commodities? Because pricing stability in commodity markets relies on one thing: confidence in conversion, confidence that paper converts to physical, confidence that delivery works, confidence that the warehouse receipt represents actual metal you can touch. When that confidence breaks, premiums explode first. Price follows later, sometimes violently, sometimes awkwardly, but it always follows. Right now, in silver, we're watching the confidence break in real time. China values immediate metal. They're paying $128 to have it now. The US system values liquidity and contract rollovers. They're comfortable at $111 because most contracts never demand delivery. That gap between 128 and 111, that's the signal. That's buyers saying, I don't trust the conversion anymore. Circle this. When you see a regional price detach from the global futures price, you're not watching a temporary arbitrage opportunity. You're watching structure crack. Comment watching if you're tracking silver right now. Let me show you the second layer most people miss. This is where bullion banks quietly get nervous. I call it premium decoupling. It sounds academic. It's not. Here's what happens. Regional pricing fractures. Arbitrage becomes impossible. Or someone makes it impossible. Inventory becomes political. Let's walk through it. Normally, if Shanghai silver trades higher than London silver, arbitrageurs step in. They buy in London, ship to Shanghai, pocket the difference. That flow keeps prices aligned globally. But what if shipping takes too long? What if export restrictions suddenly appear? What if warehouses start limiting withdrawals? Suddenly, arbitrage doesn't work. The price gap stays, and it widens. You end up with two silver markets, one that trades freely on paper, one that rations physical access. We've seen this in other commodities. Palladium in 2020, nickel in 2022. That was spectacular. Copper during various supply crunches. The pattern is always the same. First, premiums tick up quietly. Then, someone who needs delivery starts panicking. Then, futures prices become irrelevant to physical buyers. Then, and this is the part that shakes markets, someone big realizes they can't deliver on contracts they've sold. Not telling you that's happening now, showing you the pattern to watch for. Because if delivery keeps winning, if physical demand keeps pulling metal out faster than supply refills it, you get three possible paths. Calm resolution. Supply flows increase, premiums normalize, stress fades. Temporary suppression. Paper price gets pushed down to shake out weak hands while physical gets rationed quietly. Delivery strain escalation. Someone fails to deliver. Contracts get cash settled involuntarily, and the market reprices violently. Your job isn't to predict which path. Your job is to recognize when the path is shifting. Right now, we're on path 2 or 3, not path 1. I'm watching this because I've watched physical markets disconnect before. It's never just about price going up or down. It's about who controls access and who gets rationed out. This isn't about being bullish or bearish on silver. It's about knowing when price lies. When the paper price says $111, but you can't actually buy metal at $111, what's the real price? Physical or paper? Which do you trust more? Drop a comment. And here's the part almost no one watches. There's one number flashing right now that tells you how much stress is in the system. Registered inventory at Comex. Most people look at total inventory. Wrong number. Total inventory includes metal that's just sitting in warehouses. Could be earmarked, could be held for long-term storage. Doesn't matter. Registered inventory is deliverable against contracts. That's the only metal that actually backs the paper system. And it's bleeding. When you see million-ounce withdrawal days, and we just saw one, that's not normal volatility. That's someone saying, I want my metal out of the system, now. Could be industrial buyers securing supply. Could be funds moving metal to private storage. Could be international buyers taking delivery and shipping overseas. Doesn't matter who. What matters is the flow. Imagine you're a bullion bank. You've sold short contracts, standard hedging, nothing nefarious. You've sold those contracts assuming most will roll over. Most buyers don't take delivery. They trade the price move, collect profits, move on. That assumption works until it doesn't. Now imagine 30% of contracts suddenly demand delivery. You need metal. Registered inventory is your safety valve. If registered inventory is draining while open interest stays high, you've got a mismatch. Too many claims on too little metal. Think about that. The warehouse receipts say the metal exists. But if everyone showed up to claim it at once, musical chairs. This is exactly what happened in nickel on the London Metal Exchange in 2022. A massive short position. Delivery squeeze. Price went from $25,000 per ton to over $100,000 in 2 days. The exchange halted trading, canceled trades, forced cash settlements. The paper market broke because the physical market couldn't deliver. I'm not saying that's happening in silver today. I'm showing you the pattern to recognize stress before it snaps. Right now, Comex silver has the symptoms. Draining registered inventory. Check. Widening physical premiums. Check. Regional price decoupling. Check. Could reverse tomorrow. Supply could flood back. Demand could cool. But right now, the structure is stressed. And the crowd isn't watching. They're watching the price chart go up or down. You're watching the flow underneath. That puts you in a different group. The group that sees stress early. Here's another signal most people ignore. Silver lease rates. When lease rates spike, it means someone needs to borrow physical silver right now. Why borrow silver? Usually to deliver against a short position or to fulfill an industrial contract. Spikes in lease rates mean short-term physical tightness. Small spikes, normal market function. Sustained spikes, stress. If you see lease rates climbing while premiums widen and registered inventory drains, you're looking at a cluster, not one weird data point. A cluster of stress signals. Can't know the timing, only the structure. Here's what you need to sit with. The question isn't, will silver go higher? The question is, what happens if delivery keeps winning? Because if physical demand continues pulling metal out of the system faster than supply can refill it, someone gets caught. Could be a bullion bank. Could be an industrial user. Could be a fund with leveraged exposure. But someone ends up scrambling. And when scrambling starts, things move fast. We're talking about potential forced cash settlements, rationing physical access, delivery delays that weren't priced in, contract terms getting rewritten midstream. I've seen it in other commodities. It's not pretty. And it doesn't announce itself with a headline that says, market breaking, pay attention now. It whispers through widening premiums, through inventory drawdowns, through lease rate spikes. The whisper is happening, right now. While most investors are watching price charts and asking, should I buy? You're watching delivery flows and asking, who's moving metal and why? That's a different game. Let me show you 3 paths this could take. No certainty, just structure. Path 1 is pressure release. Supply flows adjust. More metal moves into registered inventory. Premiums cool back to normal ranges. Shanghai and Comex, prices realign. Delivery concerns fade. The market digests the temporary tightness and moves on. Who benefits? Patient holders, industrial buyers who secured supply early. Who struggles? Leveraged longs expecting a squeeze that doesn't materialize. Path 2 is grinding stress. Inventory bleed continues slowly. Premiums stay elevated but don't spike higher. Regional pricing stays fractured. The system stays stressed but doesn't break. You get months of tight physical conditions while paper trades in a range. Delivery gets harder but doesn't fail outright. Who benefits? Physical holders, anyone with access secured. Who struggles? Late buyers paying sustained premiums. Anyone assuming stress will resolve quickly. Path 3 is a snap event. Registered inventory hits critical lows. A large player demands delivery and can't get filled. Forced cash settlements trigger broader awareness. Price gaps violently as physical reality overrides paper pricing. Rationing becomes explicit. The market reprices in days, not months. Who benefits? Anyone holding physical before the snap. Who struggles? Everyone scrambling after, not predicting which path, watching for signals that show which path we're on. Here's what I'm tracking this week. First signal, Shanghai physical premium. Normal behavior is a $1 to $3 premium over Comex. Stress behavior is a 10+ premium sustained. Current, $17 premium. What it means? Physical demand in Asia is overwhelming paper pricing. If this premium narrows, stress is easing. If it widens further, we're moving toward path 3. Second signal, Comex registered inventory changes. Normal behavior is small daily fluctuations, net stable. Stress behavior is consistent large withdrawals, declining trend. Current status, million-ounce withdrawal days, downtrend established. What it means? Metal is leaving the system faster than it's entering. Watch for inventory stabilization or acceleration. Stabilization suggests path 1. Acceleration suggests path 3. Third signal, silver lease rates. Normal behavior is low, stable, boring. Stress behavior is sudden spikes, sustained elevation. Current watch level moves above 1 to 2%. What it means? Physical borrowing costs rising equals someone needs metal now. Sustained high rates equal persistent tightness. Fourth signal, backwardation signals. Normal behavior is futures trade at a premium to spot. That's called contango. Stress behavior is near-month contracts trade below spot. That's backwardation. Current. Watch for shifts in near-month contracts. What it means? Backwardation means immediate delivery is worth more than future delivery. That's physical dominance. Fifth signal, open interest versus registered inventory. Normal behavior is registered inventory, comfortable relative to potential delivery demand. Stress behavior is open interest high while registered inventory drops. Current. Ratio tightening. What it means? Too many claims on too little metal. If open interest drops sharply, longs are getting shaken out. If it stays high while inventory drops, mismatch is building, not advice. Pattern recognition. If you're an active trader, these signals help you respect volatility and manage position size. If you're a long-term holder, these signals help you understand whether your thesis is playing out or falling apart. If you're watching from the sidelines, these signals show you when the game is changing. Risk cluster to keep in mind. Liquidity, risk. Physical markets can dry up fast. What's available today might not be available tomorrow at any price. Counterparty risk. Who's on the other side of your contract? Can they actually deliver? Time mismatch. Futures contracts assume you can wait. Physical demand doesn't wait. Policy interference. Governments can restrict exports, limit withdrawals, freeze trading. Happened in nickel. Could happen again. Forced cash settlement. Your contract might get settled in dollars, not metal, if delivery fails. Repricing windows. When markets snap, the move happens in hours. You don't get time to adjust. I'm watching these signals not because I know what happens next. I'm watching because I want to see the structure shift in real time. You're doing the same thing now. What signal would make you reassess? Drop a comment. Here's what separates the group that gets shaken from the group that stays grounded. If you watch signals, you're not guessing. You're observing structure. If you respect flow over price, you see moves before headlines announce them. If you stay disciplined when others panic or chase, you put yourself in position to act instead of react. This silver situation might resolve quietly. It might grind for months. It might snap in a week. Can't know. But you're not here to know. You're here to watch. We track stress early. We don't chase headlines. We respect cycles and patterns that repeat. That's the group you're in now. Subscribe if you want to stay inside this loop. We're watching together. Premiums, inventory, lease rates, delivery flows. Share one thing you're watching this week in the comments. Help the algorithm show this to people who need to see it. Before we go, remember this. Markets don't break loudly. They don't announce structural problems with flashing red lights. They whisper first, through premiums that shouldn't be there, through inventory that shouldn't be draining, through regional prices that shouldn't be decoupling. Silver is whispering right now. You heard it. Most people won't until it's already moved. That's your edge, not prediction. Observation. Stay sharp. Links in description. See you in the next one.